Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I really appreciate that. So, today I'd like to talk to you about HCOW because I just discovered it and I am disproportionately excited about it. So, and I know this is not what I typically kind of cover because I am distracted by shiny objects, but I am actually pretty excited about this. So this is from Amplify ETFs. It is the Amplified Cows Cover Call ETF. And what they do is, if you look at the prospectus, they use the cows, the securities that are in the cows ETF, but the cows ETF tracks the Syntax 3000. They pick the top 1,000 companies, and then and this is large and mid cap companies, and they pick the best ones for dividends and the ones that have the most cash flow. That's why they're called cows. And for me, besides the fact that they do have 2 whole years of historical data for us to look back at, for me, it's the inclusion of mid cap because nothing else that I do is mid cap, and it excludes finance. But like my portfolio right now is pretty overweight in things like Bitcoin and AI. So having companies that actually have good fundamentals and in an ETF that has shown that it can increase over time. Like let's look at the distribution history. So you look at 2023, we started at 17 cents per share. And then in 2025, the latest one was 24 cents per share. This is what you want in an ETF that is paying you income. You want the price and the distributions to go up over time, as long as you're beating a savings account. Like I don't believe that HCOW, when you are trying to benchmark it, is going to, in a regular market, that is going to beat a lot of benchmarks. There is one specific scenario that this is not financial advice, it's just my theory and my hunch, but there is one specific scenario that I think HCOW will outperform, and I will be happy to have this be 1 to 5% of my marginable account. And the thing is, because this is not going to outperform QQQI, this is not going to outperform SPY, because this has a 12.27% distribution rate. And you all know me, I'm not normally someone that gets excited about things with lower distribution rates, but there is like there's like a oxymoron. Like basically, if I don't get into things that have lower distribution rates and actually appreciate over time, I will, in the medium to long term, my portfolio will not be sustainable. So I have to be in higher income things now because I need money right now. But I do need to start looking into the future and getting into things that are not dividend traps and making sure that in the long term, my portfolio is sustainable. And I am trying to get my portfolio to, be less risky and go down less in the downturns. So I don't think I finished that other thought before, but the one scenario I am looking at is when we have the NASDAQ 100 going down 30, 40, 80%, whatever it happens to be, I believe HCOW, it'll still go down because it's still equities, but because these are really fundamentally strong companies that have good cash flow, I believe these companies will recover better from a crash and it won't go down relatively as much during a very severe correction. So to me, getting the 12.27% in something that the companies are more fundamentally sound, and it goes up less than the SPY, but also goes down less than the SPY, I think as something to balance my very, very aggressive portfolio, for me, that is what is fascinating for me for HCOW. So this is a preview of what I'm doing with YieldMight. Basically, I had the minimum maximum over here, but it made this side section too wide, and so you couldn't really see, you couldn't see YieldMight and the filters and the cards at the same time, so I moved it up here. But let's say you want to, because 10% is a little bit low, so you want to customize it and say, I want to see things that are at 12% or more, and 200% obviously too much. And that's arbitrary, by the way. If we ever get a fund that's over 200%, I will add more to this. I just think that that's, this basically is saying no filter. Anyways, we say anything between 30%, 12% and 30% are things that I would like to look at. And we even go into advanced and we can click distribution rate. So DSO is Disney, it's a single stock ETF, but XDTE has a 25% distribution rate. So I could, instead of doing HCOW, go into something that is basically the S&P 500 or gold, KGLD, or a closed fund like CLM, or a fixed rate thing like XPay. So, and there's silver and Berkshire Hathaway and things like that we could also look into. And there's other, I'm not as familiar with these, but these are pretty much sector specific things from SSGA. So when I'm looking at things that pay a lower yield, I am looking for, because it has so much competition, because if we're looking at this, but if you say I want the maximum to be 150% and not this custom amount, but the minimum is a 60% yield, I guess we have SLTY, but there's really not as much competition. Let's make that a little bit higher so I can prove my point. So if we're we want a 90 to 100% distribution, there's not relatively as much that out there that pays almost 100% distribution. Most of it, all of it is, it's single stocks. Yeah, all of this looks like it is single stocks. It's very risky. You cannot have over 100% yield and it be a safe or type of investment. So when you go back and you say, well, if I want a 10% to a 15% yield, I think that is sustainable and it creates capital appreciation, then you have way more options available to you, and it just depends on what your own convictions are. So do you believe in the SPY? And even if the SPY goes down, do you believe that it'll bounce back? Do you like gold? Do you want more exposure to big tech? Do you want to follow some random celebrity? I'm sure that Ackerman is a well-known person. Whatever, it's fine. Or do you want to do the NASDAQ 100? Or there are a lot of options if you want this particular distribution rate. And a lot of them are really good in their own right. It just depends on what your personal thesis is. And my thesis was, I was making enough money weekly for the last 3 months that I can stop being so aggressive in aggressive ETFs and take the time to be in some things that are lower beta, that are better composition in their funds for the long term. So I did buy like 20 shares of HCOW, but it turns out that when you sell something that has a almost 80% distribution, and then you buy into something with a 12% distribution, that there is a little bit of a difference between, because I sold out of some of my SLTY and my WNTR, which I don't think WNTR, we have to do above 150% to even show winter over here being so when you have something that's paying 126% distribution and accidentally becomes 12% of your portfolio, and by you I mean me, this has happened to me. So I don't want my inverses to be more than 10% of my portfolio each, and both of them equals to 20% of my portfolio. I think 20% of my portfolio and inverses for now is enough. But when you take something that is 126% distribution rate and you put into something that has a 12% distribution rate, there is a difference in the income that we make. And so I'm not really changing the strategy. I do think that me going into things like HCOW and maybe something like QQQI, things that have proven that they can appreciate over time, that are more diversified and better for the long term. I do think in the long term I will be better off if I continue to do things like that. I do need to start doing more options for myself to make up that lost income. But I do think for me to make me being fired, me being fine, sustainable, I do need to start going into some of these funds with better fundamentals. So basically, HCOW gives me exposure to mid-caps, which nothing else does. These free cash flowing companies, I think, will do better in a major crash relatively than basically being in the NASDAQ 100. I am capable of doing things like running my own dividend wheel on TQQQ if I really needed to, and I found $20,000 to do that. Like in a big market crash, I might be able to do that because it would be less money, and it's 3x the NASDAQ 100. So that might be an option that presents itself to me in a very big market downturn. But I think being in better funds like this and having it being a bigger part of my portfolio means that maybe someday I can stop like hedging with an inverse and just have a better diversified portfolio in the first place, which is what I would prefer to do. I would prefer to just not have inverses at all and just have better funds that are more diversified in my margin account. So we will see how this works out. This is not going to be more than like 1% of my portfolio for the near future. But I did go and just, for the last 6 months, cows on a growth basis has been growing more than SCHD. Of course, if you cherry pick and you use any other time period, it kind of loses out to SCHD. But there is, in fact, a time period where if you had invested in cows in June when it dipped, or in May, April when we were having the dip, it would have appreciated more than SCHD. And that's not guaranteeing anything in the future. But I am saying there is a time period where we could have used SCHD as the benchmark and you had more price appreciation. and you're getting paid 12% versus SCHD's 3%. And so I did this. I did totalofreturns.com, which assumes that you're reinvesting everything. But because SCHD, BNDI, and HCOW have been around for a while, we were able to do from September 20th, 2023 until now, you would have had the most total returns from SCHD. HCOW is in the middle, and BNDI is the least. But from the beginning of this year, or actually for 1 year, from November 11th of last year until November 14th of this year, which we had a big crash, and then this particular last week was a downturn. So for 1 year, BNDI, you would have had the most money. SCHD, you would have the least amount of money. And HCOW is in the middle. So I don't particularly want to be in bonds right now. So for me, I think HCOW is kind of just in the middle of the road. It's not going to appreciate a lot in value, but it's definitely not going to be like some of the more dividend trap type things that I have found myself in. So, and yeah, that's my opinion of HCOW. What are your thoughts on this? And I will talk to you all later. Oh, before we go though, I would like to thank all 4,106 of you that have decided that I am interesting enough to subscribe to. I really appreciate you all, and this is so exciting. And I would also like to thank the 12 of you that have decided to make your bad financial decisions together with me. I'd like to thank Jetta, Omega World Effects, In My Opinion, BGP Automotive, Patrick Spalding, Bill Bryant, Shane O'Mac, Michael Holliday, Scott Behringer, Paulette Pierre, Russell O'Malley, and Eric. You all are amazing, and I appreciate all of you. And I'll talk to you later. Bye.